Should I enter off of a fair value gap or an order block? Yes, wait no, actually yes and no. Well, it depends. The first thing you need to understand is, why did ICT first solely enter off of order blocks, and then why did he change to entering off of imbalances only? What did he actually find out? What was the reason behind him switching? This is what we will be diving into during this video, so stay tuned. If you would like to join the academy and be a part of the membership, then click the link in the description. Now back to the video. So the whole basis behind entering off an order block is that there is a pileup of orders from large entities that are moving price in their desired direction. So in this case, you are trading with the banks or the big boys. Whereas entering off a fair value gap is when price, i.e. the market algorithm itself, needs to mark price efficiently because it was unable to do so previously. So you're actually trading along with the market algorithm itself. So as we can see, order blocks equal to trading with the big banks, and fair value gaps equal to trading with the market algorithm. As we know from our experiences that sometimes an order block works and other times it doesn't. The same goes for fair value gaps too. Sometimes they work and other times they don't. So this begs the question, who should we pick to trade with? The big banks that manipulate the markets, or the market algorithm itself? Tough question, right? What if I said to you that actually this is really simple? All you have to do is decide whether to enter off an order block or a fair value gap and see who is in control of the move. Is it a large entity, or is it the market algorithm? Let's look at 3 examples to see when to enter off an order block, when to enter off a fair value gap, and what to do when we are not sure. If we just look at this piece of price action on the 30th of November, I'm not going to use the replay tool because we don't really need to, but let's just have a look. So we have this price action, and as we can see on this time frame, which is a 5-minute time frame, we can see we are moving to the upside quite nicely. Now, as we're moving to the upside, obviously we're looking at structure, and structure is very important when looking for something called order flow. Order flow basically tells us where the banks want price to move to, because when banks get orders, they have to fulfill these orders, and then obviously they need to push price in a certain direction so those orders are completed, and then once they are completed, then they don't really care about where price goes after that until they get their next order. And so essentially we are looking at this piece of price action and saying, okay, so are the banks going to, or are they manipulating price? So if we look over here, we can see price comes down, pushes up, pulls down and pushes up. Now at this point here, we actually react off an order block, and I'm just going to zoom in a little bit so we can see this a little bit better. We react off an order block. We know the trend is moving to the upside, and we get some, breaks of structure, trend continuation sort of thing over here. So we can see price is moving to the upside. Now we have that price pulled back on this leg, reacted off of something here, and this is actually something on the lower time frame, on the 1 minute. So we know there's order flow starting. So we got this move up here, move down, push up higher again, and now genuinely when it comes to order flow, we're looking for price to react off an order block and for an order block to be left behind. Clearly we can see from this move here to the upside, we get a very impulsive move. That's a very good sign that banks are in control of the market. And then we are looking for an order block, which we have very nicely over here. This can be refined onto like the 3 minute or something, but I'm not really going to go down to that time frame now. But what we can see is price comes down, and the move down has to be somewhat correctional. And as we can see, we get that, right? Price firstly fails to make a higher high, which is a good sign that we're going to come down, and it's also a good sign that this low will get taken out as well. And then we come down very nicely, we tap in, and then we move away. So when it comes to taking a trade like this with these sort of confidences I've just gone over, we would be looking to enter at this point here with stops just below the order block and then targeting the highs. And as you can see, you'd get a very nice risk reward. I'm pretty sure you get a 1 to 5 as well, which we do. So essentially in scenarios where we can see price creating order flow and reacting off of order blocks, that's where we want to enter off of order blocks only. And as you can see, if we did enter off an imbalance here, then we would only be doing ourselves an injustice because our risk reward isn't as good as it could have been. Now that we've gone over entering off an order block, when do we enter off an imbalance? So if we think back to ICT, and when he teaches to enter off an imbalance, he looks for one thing first, and that is liquidity to be taken. So if we look at this example here, we can clearly see we get liquidity from the downside being taken over here. So that's this point there to here. So we got the liquidity grab, and then as soon as we get the liquidity grab, we're looking for an entry point and some sort of breaker structure. We don't really get a breaker structure because let's say the structural point's over here and price moves down, then pushes up again, and then we can start to see we begin to come to the downside. And this is a good sign because now we can enter into this trade. We also know the trend is up as well, so we want to be alongside the trend. And if you looked at this on the daily time frame, your daily bias would also be to the upside. So very simply, we look to enter off an imbalance, right? Because this trade has confluences that are aligned with ICT's trading style. So what we can see is we have an imbalance over here and an imbalance over here. Now the only problem with entering off of imbalance is we don't know which one to enter off because we don't know where the true imbalance is, and I'll go over that in a separate video. So what we have to do is we have to incorporate both of these imbalances into the trade. So essentially we would be looking at something like this. So we'd be entering off of the imbalance like that, and our stops below the like swing high point or a candle essentially. So we could even have it at this point here because we expect price not to come in or push further than the imbalances. But because we know that this is an order block, we should cover that as well. So now that we've done that and we've covered the entries and the order block to the downside, we can have targets to the upside. And obviously from here, we know that the buy side liquidity will be this here. So then your trade will be something like this. Obviously not the best risk to reward, but because we know that the daily bias is to the upside, we can leave runners, and there you go. You get a very nice risk to reward of about 3.58, and then the highest is 1 to 5. Perfect. So both trades that I've shown you, both the examples are 1 to 5, and that's a good thing. Now here's the thing, right? If you looked to enter off an order block only, you would get missed by this trade because price reacts off the imbalance, because this trade was a liquidity grab trade, and generally most liquidity grab trades tend to react off of imbalances more than they do when it comes to order blocks. That's something that I've tested out and I found out from my back testing. But the main reason is because we know who's in control, right? It's not the banks, it's the market algorithm itself. And for our final example, we have this. What do we do when we don't know whether to enter off an order block or an imbalance? So looking at this piece of price action, we can see that price is clearly struggling to continue to the upside. So we know that sells are likely to happen. And what we can see is we start to get, these highs put in and price starts to break down. So my eyes are really focusing on this piece of price action over here, right? So this piece of price action over there. So looking at this piece of price action, I'll zoom in a little bit. What we can see is, okay, we start to get breaks of structure, and then we're thinking, okay, so who's really in control here? Is it the banks or is it the market algorithm? So at this point here, we get this push down, which breaks structure and then pushes back up again, and then it reacts off of this order block. But we understand that we have liquidity below that price can target and liquidity above that price can target, and we don't really want to be caught in the middle of a range, right? So essentially we want to see which way does price break out from and where can we enter from. So we wait for price to do its thing, it breaks structure again. Now we're thinking order flow, and then price goes and grabs the liquidity. All of this liquidity here, including these lows there, this low here, and all of these lows are taken out with a nice impulsive move, and then price starts to come back. Then what we can see is we have an order block over here that we can enter from. I might as well just cover this high as well. And then we have this imbalance. As we can see, the trade actually doesn't get triggered in because who was in charge, right? We thought it could have been the banks or it could have been the market algorithm. So the best thing to do in this case would have been to enter from the imbalance and covering the order block. So when you're not sure, cover both aspects. So in this case, your entry would be here, your stop would be just above, and you can take the trade to at least the lows, which is a nice 1 to 3 trade. So this is what I do, and I've implemented into my trading to ensure that I don't get missed as often as I did, because sometimes order blocks get missed and that is really annoying. And so learning from ICT during his ICT mentorship, I have learned to incorporate imbalances when they make sense. Now the only time I wouldn't incorporate an imbalance if it's too big and it ruins the risk reward for me, then there's no point in me taking that trade, in my opinion, because having a stop too large ruins your risk to reward, and then in the long run, when you're obviously looking at your win rate and your risk to reward, it won't make sense. And that's it for this video. I've had a lot of DMs asking how I tackle this in my trading, so I hope this helps out. Thanks for watching, like and subscribe, and I'll see you in the next one.